Good
Morning, bro. How are you?
morning, man. Tyler,
Been a while.
been a while. Been a while. All is well.
Always, bro. How about you?
Can't complain. Can't complain.
Good,
Spent
good.
Ended my week at the park. Got in like almost midnight. Was just there with the kid. Mrs. just looking up at the sky, and I was feeling super grateful.
Enjoying the weather, yeah?
Oh yeah, nothing like
Right.
the London boys.
I have snow here, bro, so I'm jealous.
Ah, it's the downside
Soon
of
enough, I'll
it.
be away. Soon enough.
All good,
All right,
man.
I'll let you get into it, bro. We'll talk soon.
All right, cool. So, morning again, everyone. Not sure how many persons are on. 6 persons, okay. We'll get started nonetheless, and then jump in. Um, so first off, we mentioned that we wanted to do it kind of like a review video, and then get into some conversations. So one of the first things, let me check. I'm sharing screen versus okay, cool. This one. One of the first things I would revisit is this chart here. So let's start with this. Save me some time. So at the start of the week, this is the chart I shared um, in the Discord group. Pretty straightforward for the persons who've been with me for some time, but I still took the liberty of walking you through this analysis. Um, I want to say Monday, but I doubt it was Monday. Whichever day we did the call, you will remember. So it would be only fair to start a review by reviewing what we wanted coming into the week and how it played out. So, if I'm not mistaken, this is Monday. Yes. So the week started without this delivery here. So as we discussed, you can see that this big guy right here is an order block, imbalance, all of these daily highs, failure swings inside an order block, high probability. This was a refinement of 15 minutes, so that can be ignored. Old daily bullish order block here, but hit it the week prior and then kind of rallied up into the buy side liquidity. That was right there. Order block buy side liquidity, bias is determined right off the bat. You have a big order block, liquidity is inside it. You want to see what happens at liquidity. In an ideal world, it's always preferred for me, in my opinion, that when you have setups like this, you don't see the market trying to close above it. Okay. So if we start off by saying bearish order block with buy side liquidity inside it, in a perfect world, it's better to see them just wick that and go. And that's like a rule. For here, how I would journal this is we did not close below the liquidity pool. We ran through it. But things to note would be one, the buy side liquidity was just above the open of the order block and it had a fairly decent sized body. And two, we didn't get closes above 50%. Now, I'm not saying that this would be a rule, like this portion of it, it would be an observation that could help with tape reading live price action. So let's say we're looking at like a 5 minute or a 1 minute chart, and we start seeing a signature again that looks like this order block, liquidity inside, and the liquidity is just down, these portions. Then I could say, I'd like to see them run this liquidity and then go lower. But if I see it stab through, close above, I want to see if it's trying to close above 50%. And I'll use that to determine should I enter now based on my bias or should I wait for a little bit to see if there's something more pronounced. Nonetheless, we're on the buy side liquidity. Big Monday, Monday taking Monday high, the unicorn, and then beautiful delivery lower. This day, Wednesday, I think I did a call on Wednesday because I remember saying my bias for the next day is likely going to be derived from where this candle closes. This is something that you can use probably most times, kind of help you stay on side or stay with order flow or current order flow. Watch where consecutive candles close, especially in relation to the previous candles close. So mechanical definition, big green candle. You want to see if this green candle is closing above this candle's close, which by definition sounds silly because a green candle is going to more than likely be above this candle's close. But watch where it closes in relation to, let's say, the open to the high. There are relationships that can be derived or rule sets that can be created from that, which is why here I said if we closed above this candle close, I'd look for a deeper run and then roll over. Objective at the moment for me hasn't changed. One buy side liquidity pool, one sell side liquidity pool. So I'm looking to see this guy go lower. And pretty much wraps up the daily chart. I don't think there's any reason for this market to get back above here. If we are going to retrace, then somewhere between this 3-bar low and the closing price here, I'd consider this as being irrelevant. This 3-bar low, this closing price, I'd fib that, put a line there, and that's where I don't want to see bearish signatures print. So bearish order blocks, not trying to expand through, all that good stuff. But we'll see next week. So let's jump into like a H1 chart and then dice this guy up and see what we can learn from last week's delivery. Let's go back over here. Put that open. Save me some time. Here. So no liquid, no indicator on, but I guess for reading, I should have this here. So we know what key level this is. Sell side liquidity is right here. Near term, it's inside the range, so near term. And those should be my basic key levels from a liquidity perspective. Range lows are obviously going to be the lows that are lower than previous lows because that shows like a run on liquidity. But because I like liquidity, I don't like looking at places that run liquidity for liquidity. Just doesn't make sense to me. So here we are. We opened one-sided delivery all the way up into buy-side liquidity pool. ICT purists would look at something inside here like a breaker narrative. Drops, doesn't get anywhere. Classic market structure shift would now tell you that if we have a high, then a higher high, and that higher high ran liquidity, the low between the 2 points, or the lowest low between the 2 points, is classic market structure shift. So this should resonate with at least one person because I spoke about this with them recently. So if you have no way of determining bias, this is a real easy duct tape approach to finding what direction you should be looking at. High, higher high, the second high takes liquidity, low in between, close below, easy. Wherever else you see that, then it could work. So low, lower low. If liquidity was run with this low, You find the highest high between these 2 points, which would be here. Close above here. You start stalking bullish setups, whether that's a retracement or whatever. Likewise, bam, bam, bam. Yeah, cool. So market trades up Monday. Tuesday broke hard, all the way into the close of Tuesday. And then we pretty much stayed below here, immediate rebalance idea, and then run the sell side liquidity. The delivery inside it was a little bit messy. So it's not going to tell you what you probably want to hear. Do I go in now? Do I trade now? But it tells you what to look for. Closing below here versus not closing below here says this market is ready to move. Outside of that, this structure shouldn't be deemed unfriendly. It should be looked at like we dropped, created a low, expanded through. I gave a very, very mechanical way of looking for gaps that stay open. If you have a pool of liquidity, so any lows that didn't take liquidity, the lows that are above big FEGs, like regular liquidity pools, if you see a delivery that prints in that manner or this manner, where we have a liquidity pool, whatever happens here, we take the liquidity pool, the specific candle that takes it, the very candle that trades below the liquidity pool, when it closes through there, so if you've ever seen me doing a recording, probably one of the old ones, where I point to something like a particular low in a, let's say in a sell, and I say this is sell criteria or speed criteria, and or I say that I want to see a FEG print here, or before the FEG prints, we have a low and a body goes through, and you see me draw something like a box highlighting the FEG when the FEG hasn't formed yet. It's because I'm expecting right there to print a FEG that should stay open. Very mechanical definition. Liquidity pool. We take the liquidity pool, then we close through whatever point to the liquidity pool. FEGs that form right there. Put the arbitrary one. FEGs that form right there. In my journaling, I'm not going to say experience. In my journaling, generally stay open. So, if you take a look at candlesticks to make it a little bit easier, if you take a look at candlesticks and you look at, let's say this low here is higher, this candle at 6 a.m. would be the one that takes this. So in real time, if this was like a 1 minute chart, the first thing I would do is put a line on that low. And I'm now expecting a FEG to form here to send this lower fast. So two things automatically pop up in my mind. Listen closely. Number one, there must be a candle high that prints that is below here. That's my reference point. For real quick and easy setups, it's going to be the candle right after. Everybody knows that. What happens when it does not print immediately? That becomes the reference point. Right here, this, I want to say FEG from here to here. Somebody's going to execute me. This right here is going to be the most significant portion of price action right here. This will tell you If something happens here, this is what it means. Okay, so listen closely. If right here is the FVG that I'm expecting to be a breakaway gap, what does it mean when this candle here trades up and fills it in? It means bullish bias will be derived from this candle's high being taken, and vice versa. Top, 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 whatever. Once it closes through here with a down candle, you don't want to see anything coming back up here. In a perfect scenario, there are going to be instances where, price is a little bit messy. Doesn't matter if it's messy or not. What matters is if you can read it and say, this is what it should do, so this is what I'm going to do. Breaks fast, creates a big down candle. You don't get super excited and think this is going to be an order block. No, you go back to why or what you want to see here. It's the key level. So now something must print at that key level. Breakaway gap was expected to be here. This displacement requires no rebalance. That's probably a lot to take in. This displacement requires no rebalance. Comes up, leave all that open. Not a perfect example, but the logic should be clear. Then it breaks lower hard. Everything here is just cakewalk to trade. So for right now, I don't need to look at how many pips is in the weekly range. Where did the weekly candle close? What's the 50% of the week? And we don't need all that. All we need right now going into next week is this right here. So take them off. This is how I'm going to plan for next week. This is my planning for the next week. If this market retraces for whatever reason, just be mechanical. Today's what, the 11th. Next week. Okay, next week looks very animated. Tuesday high of the week would be my ideal consideration. So, I mean, why? Because I don't like Mondays being the high of the week. So with that being said, I would like to see next week open up, trade lower. If Monday retraces, I would ideally not want to see Monday above here. That's ideally. If something happens, then I'll read it in real time. But ideally, I don't want to see Monday's low below here. Tuesday stabs into it, high of the week, breaks hard. Simple. So for trading next week, everything I want can be derived from right here. 2104, 300 points, or 320, but 300 points of range. That should be enough to frame anything. Now, if I look at this and I say, well, it's a range, and just eyeballing, we're sitting in the middle of it. How can I derive key levels? What was happening when the range was being created? Down candles, we're closing below, we're closing below. This right here, 10 o'clock, 10 a.m. is the last time a down candle closed below a previous down candle's low. This low has to be significant. Market trades down, put a lower down candle, then we displace through it fast. Here. That right there is textbook mechanical bullish order block fractal. Because Monday has no volatility or no news, what I want to see here, I cannot be too demanding. So some type of playing around, maybe just messy delivery. And then whatever happens here is just all downside. This is the ideal fractal with Monday's high being here, 2 consecutive relatively equal highs, and trade above them. Beautiful, beautiful, beautiful. Now, for journaling, assuming that you haven't journaled anything yet, I prefer journaling from the M5 chart. So every day I go back to Monday. This is how I journal to this day. I haven't changed that mark on Monday, 4 a.m. open. I tag and label that weekly open price. I tag 8 a.m. open. And I look for what happened right after 8 a.m. in relation to overnight session, how it traded, ideally up to 2 p.m. inside here. If you're new to, well, not new to trading, and I don't want to say new to journaling. If you're new to, how do I put this in words? Let me explain it. And then if you understand the explanation, then the words will, or the ideal words will be less important. Price has a fractal nature where the same things generally repeat more times than not. If you want somewhere to start where you say that this is what I'm going to expect from price, study like this. It's real easy, real simple, just generic. Between 4 a.m. and 8 a.m. This is not precision derived, this is narrative derived. So I know some persons are going to say you could end it at other times, you could start at other times. That's not the point. The point is to discuss something that you probably already know, because ONS was taught years ago. How to look at the market and trust that something that you understand is taking place. You need this range, 100%. You always need this range until you transcend, I dare say transcend, just looking at basic analysis, and you can now read it with a little time stuff in it. This is how you want to start. How does this range impact the delivery here? Okay, again, ignore what happens after. Ignore if the run was a little bit lower, you could squeeze another 20 points. Just focus on how can I effectively trade 8 a.m. to 2 p.m. using information. I'm choosing my words carefully. Information derived from right here. If you don't have the luxury of trading 8 to 2 p.m., have no fear. Stop this right at noon. How can I trade 8 to 2 to noon, 8 to 11, 8 to 2 using information derived from right here? And then you can start getting curious. Eyeballing, this looks like a deviation of here. Yay. One deviation is here. Didn't get to one deviation. Always note, anytime you have, I don't think I said this. Other guys, just remember. price is a way of, or maybe the low wasn't, it's fine. Price has a way of bending our wills because we know that the delivery is always
Yeah,
algorithmic and precise. However,
yeah,
we we expect every little thing, like every component, to be 1,000,000% precise every single time. So we miss out on opportunities that are essentially like walking the dog. It's that easy. Anytime price does something that is not textbook, don't pay attention to, oh, it didn't do this or it didn't do that. Try to understand why. And that's how you can learn to expect when it's not going to be perfect. Find the pip count. Find the 50%. Find the open price. And you want to know, how did these levels help? How did it, could this have helped me to frame the high of the day? Potentially. It wouldn't have been precise, obviously, because it's not smack there. Somebody's probably going to say, well, you're going wick to wick. Maybe if you went body to body, then here. Sure. That's a mechanical rule you can do as well. Body to body, where did it go? Just make sure you're not trying to force fit this into this, because that's not what we do. We try to use this to anticipate this. So, mechanical reading, one-sided delivery, price retraced, found support at 50%. Did it sweep the slow? Maybe it did. Irrelevant. Then we run higher. It ran through half deviation. Here, almost hit one full deviation. Depending on the pip count here, 425 to roughly about 550, 560. From this retracement into discount to the first half deviation is over 100 points. If you could take that out of the market, beautiful. You don't need this. And that's what we don't see a lot of times, because measurements have to be right on the money. Says who? Somebody. You don't need it. Yesterday I took 9 scalps. 9 scalps. Shortest one was about 20, 25 points ish. And the longest one was about 70 or 80 points. None of those were derived using here. It was time stuff. But the point is, being able to go in and just grab something that you know is very likely to print saves you from trying to be a trading encyclopedia. I don't need to know exactly where this is. I don't need to know exactly where this is. I just need to be able to say, okay, inside this window of time, this is where it's likely to reach for, and this is how I'm going to engage. So from a Monday trading standpoint, if you can, I'm not going to do this part for you. If you can look at this delivery here, find a key level, project your key levels out, use here to frame at my key level, what's an entry fractal that printed that I could have seen? Market run up, what's an entry fractal that I could have seen here? What's my key level? What happened at that key level? That can save you a whole lot of time. The spectral edge indicator is there, but I can't do everything for you. Focus on here. So this is how I would journal on Monday. ONS, deliver after. Simple. I'll probably do Tuesday and Wednesday. Then you get the gist. And the rest is on you. Tuesday 4 a.m. 8 a.m. 2 p.m. There. Eyeballing just about. So we had after 8 a.m., market runs up. We had displacement. Remember what we talked about at the start of the call? Liquidity pool. It gets taken here. We close below. Dot, 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 dot. There you go. Another example. So here I would journal. You don't need to be in all the way up here, but if you did, then pretty easy why. Liquidity taken, no close, so no expansion higher. If there's no logic behind a breakaway gap being printed at this high, then a bullish bias being entertained is crazy. If the market can't show me that the liquidity pool was taken and we have an order block and we can't close and put a low above that, then that in itself is narrative to say that we're not going higher. Something to consider. Okay. Broke lower. This is the breakaway gap. If you want to be like super detailed, then you could draw that on a breakaway gap. You don't need that. What I'm interested in if I was journaling this is, since this is going to stay open, the high I'm concerned with is this. Breakaway gap, the high below it, IOFED. So remember the H1, what we're looking at for next week, something like this. I don't want to see Monday open inside here, then Tuesday pop above, and then it dies like that. Just like this. Breakaway gap, plays around inside here, probably a new hour. Oh, too bad, not a new hour. Pumps up, dies. This here, entertain a little bit of tomfoolery. If you have, wait, this high and this high being higher, and this second high is sweeping that liquidity, it's not SMT, right? Lowest low between the 2 points. At this point in time, when we close at 10:30, you're bearish. Real easy, real simple. Slap a duct tape on it approach. That's your bias. There's nothing about this M5 candle closing that says entry. You have to now look between here and the low of the candle that closes below that point. You have to look in there and find your key level. It could be something as simple as what Mohan just said, but I don't want to just point to that because it's hindsight. I want to share a methodology and approach that should it not look like this and it looks anything else, you can read it and interpret it on your own without saying, Kish, is this the thing or no? That's not why we're here. You're here to see it on your own when I'm not here. And then, so you want an approach. The approach would be highest high here. And this is what you'd use as your dealing range. Now, the moment I say dealing range, something should trigger in your brain about what to do here if you've been with me for some time. First thing is going to be whenever dealing ranges print, they print in a process. Okay, you never have to anticipate. Most of the persons I know that get pinpoint entries or they don't go short down here is because they understand this simple process. Dealing ranges print in a manner, and the manner that they print in helps you to understand what to expect. Buy side run, sell side run, retracement, then expand. Those are the 4 steps. So if you go to a chart and you don't know anything what's going on, and you know those 4 steps, and you can identify them on a chart, you will save yourself a whole lot of misery. Trying to short here, a whole lot of misery. We already had the buy side run. We already had the sell side run. So to complete this, I don't want to say macro because that word is PTSD for a lot of persons. To complete this process, this delivery, there are 2 functions or 2 steps that should happen next: retracement and an expansion. People have the tendency of trying to understand how to be perfect so much that they read candles right to left. Oh, it stops here. It must be because of that candle right there. It stops there. It must be because of the FEG. So they end up fitting the right side of the chart into the left side of the chart, so you can only see something after it happens. I encourage the guys that have been with me for the last couple of years to read the market left to right, not just because it's beautiful, but in a real time, this is what you'd have available to you. Most persons, again, just look at this and they just see, I don't know, I can't tell what they would see. But I want to suggest that this is what you should see. You should see that there was a buy side run, the sell side run, but we haven't retraced. But what if this didn't look like this? What if it just wicked below? All right, listen carefully. Listen very carefully. What if it just wicked below here and pulled back? 2 things are happening that could sharpen your ability to read price. The wick below and pullback is showing you the sell side run and the retracement. So in a 4-step process, buy side, sell side, in the event there's a wick, retrace when the wick comes back up, the only thing that's left is for this market to expand.
So basically, the next candle will be expansion.
In a perfect world, the next candle could be expansion. However, I'm not going to tell you that the next candle is going to expand. I'm going to tell you what to look for to show that it's expanding. So let's assume, where's the, that's it, there we go. So let's say this came down here like this, right? So we'd have 1, 2, 3, the retracement when it comes back up. The expansion is going to come when we close right there. So this line being at this low, irrelevant. You would put this line to this low. So remember, a lot of times when I'm doing like screen recordings on my phone, you'll see me put like a red arrow or a blue line somewhere. The blue lines are always where I expect the market to draw to. And the red arrows are going to be those areas that the market should avoid. And should it get to an area that it should avoid, then that's your bias. So this would be my blue line. Gets below it, close, die. Now this simple process right here is a big part of what we talked about before. Buy side, sell side, retrace, expand. This would be the liquidity pool. This would be the candle taking the liquidity pool. So that tells me next time we close there, I'm going to get a B, A, G. Hopefully it's one full of money. This means breakaway gap, right? Just real duct tape approach to breakaway gaps. Breakaway gaps. So automatically, get these off. If this was a wick, once it's taken here, I know that my breakaway gap is going to print down here. If this market should be expanding right now. If this market should not be expanding right now, I need to see the retracement. Expansions, good old ICT, are paired with order blocks. So you can look at your order block. You can look at premium of the range. You get your key level and you wait. Premium, key level, you wait. Insert Dora's voice. Is this at your key level? No. Is this at your order block? No. Why are you trying to sell? Is this at your key level? Is that the order block? No. And that's how you read it in real time. Waiting. Is this at your key level? No. Is this at your key level? No. FOMO kicks in right here for most persons. Is this at your key level? Yes. Sell, right? Now, buy side, sell side, retrace, and expansion. Once we have retraced the expansion, expansions don't, sorry, wait, no, I can't say like that. I was about to say expansions can't happen internally, but that would be a flawed logic. The expansion that you're expecting here should want to leave the trading range, not the dealing range, the trading range. So what's the difference? Well, the dealing range is the algorithmic portion that you're going to use to derive your key level. The trading range is what you're going to use to make money. That sounds weird, but hopefully you get you get what I'm stepping in, right? Trading range is what you're going to be using to trade. The dealing range or the algorithmic portion is what you're going to be using to find your key level to trade from. I'm not telling you to go and buy this low. I'm telling you to sell with order flow at your key level to target that. From your key level, trade management, right? Just to discipline me. 375 to 220-ish. Lots of points. Do you need entry and exit here to have a good morning? Because this is 11 a.m. No, you don't. You could need a run from, or not need, you could get a run from premium at 370-ish into discount at 330-ish and be done with the day right here. From here to here, you're done. And the market looks at this and you send a screenshot to your friend and say, hey, look where I got it and look where it went. That's it. Super, super, super peaceful. Not, is this the order block? Is this the order block? Is this a reversal? Oh my God. Should I buy this? No. Not in 2025, right? It's 2021 stuff. Read it left to right. Here. Mile markers are something that I kind of encourage as well, because trading can take a toll on your psychology, and it's real. There's no other way I can put this. Everybody knows what I'm talking about. Trading will suck the life out of you. It will. Especially if you're a content creator or a mentor. It will suck the life out of you. So if anybody here has a group or trying to start a group of their own or whatever, it will suck the life out of you unless you know or find a way to refuel whatever that means for you. You understand refueling, whether it be going to your journal just to sharpen your mind, remember stuff that you were trying to do, and then maybe your new mind and the old stuff you figured out. That happens to me a lot of times. Or ground yourself. I took some losses with a concept that I know and love. Let me just go and read the process again. Just something. Don't be crazy. So simple trade idea. I said I wasn't going to do it any other days, but I'm kind of in the mood now. My journaling is not done mechanical like this. Just slap my indicator on and it shows me them, and I make 2 lines, 2 notes, and then I screenshot and I post in my journal. That's it. But if you don't have that, then mechanical is always fun. Most persons will try to, what's it called again? Project the range to, getting an absolute high, absolute low. I just showed you that it's about 200 points. You slap in here, it drops into discount. You go partial break even. You don't care if it comes back unless it's a large position and you don't want to leave money on the table. You really don't care. Okay. Wednesday, 4 a.m. Wondering why I'm doing this when I said I wouldn't. I find this fun. I find trading to be fun. That's why I'm doing this. 2 p.m. Bam, bam, bam. Real quick, real easy, real mechanical. Nice confluence for anybody who's maybe way beyond this level. This never fails. The logic or the understanding behind it never fails. Here we are at 8 p.m. This is the range. Choppy day. I should say this. Now, most of the guys probably know this already, but I'm gonna say it nonetheless. A large portion of the time when the markets give you a large overnight session range, north of 100 points. Recently, we've gotten a whole lot of north of 100 points. But generally, when you have north of 100 points overnight sessions, anticipate that if we are inside it and then equities open fails to leave overnight session, we're probably going to trade premium to discount. What does that mean? Easy. Lowest closing down candle. Highest closing down candle. Highest closing up candle. And the open. These are your barriers. Not barriers in the sense of, oh my God, it can't do anything. 1 second. Yeah. In terms of like PDRA, these are going to be like your primary PDRA points. The last time I spoke about this, I feel like I did it quite loosely. This is what I mean. If every time overnight session prints, you grab the highest up candle, lowest down candle, and you try to hope something happens at these lines, you're going to fail. Simple. You're going to fail. Because most times when you have a line on a chart, this goes for most persons, even in 2025, most times you have a line on a chart, your expectation is that it's going to reverse from that price level. Why? I don't know. Subliminal conditioning or whatever. Most times we have a line on a chart, your expectation is that it's going to reverse from that level. I am conditioned to think that once you have a key level, it's what happens at the key levels that helps you to see what's going on. That does not mean that there are not times like here or here or here or here that you can just enter mechanically. But it must be within a narrative and then framework. ICT 101. Why would this be a day where I'm expecting it to just hit there and I would just sell that or just buy that mechanically and accept the drawdown? If you're expecting the market to be quiet, if you're expecting the market to be choppy, if you're waiting for FOMC, something in the later portion of the day, if the market Gives you a large overnight session. Not trying to get out of it. Do the risk management first, you know. That's it. Enter, exit. Just allow it. Allow it to show you. Or the most mechanical thing you can do is look for entry fractal at that price level, which is like textbook 101. 101. 2 down candles. Second one, closing below the first one. Then we have whoosh through that open price. This is the mechanical entry I gave you. It would have been 5 minutes early, which means taking this is going to be 100% your decision. Am I okay with that? Am I okay with the stop? Am I okay with the size? Let it rip. What do I want? Do I want the best price? Do I want this premium? You have to see these things on the chart and then know, or if you want to imbalance. I see the imbalance. You have to see these, plan your trade, and then just execute without failure. Or maybe none of that makes sense to you because you've tried it a couple of times and it fails, then try something else. So what else can I try? Well, today we talked about if you have a low on a lower low. I don't know, there's liquidity over here, but previous day's low, I assume. Previous low, day's low is there. So we have low and lower low, and we're below the liquidity pool. Highest point is here. When we close above this right there, you're bullish. If your bias is derived to be bullish at 855, what do you need? Your key level. Bias by itself will have you buying here, and it does this. Because we don't buy like that. How can I find the key level? Well, here. What if I don't know that? Then I don't know. I'm kidding. Analyze. The easiest thing to analyze is if you have low and a lower low, the lowest low is the stop on leg. That's where the stops were taken. There's going to be something inside here that you can use as maybe a breaker, which would have been this in this case. FVG in the stop on leg. Efficiency in the stop on leg. There are many things that you can use here. Your job is not to start your journey knowing what all these things are. No, cheat code. Your job is to be able to see that this fractal is printing. Right here, I would have gotten my bias. Since this is hindsight, the key level bias gave me an entry 15 minutes later. Mechanical entry, stop, market ran. I got 30 points in under 20 minutes. And then depending on how long you trade for, right there, the very first candle, 60 to 40 points. You got 40 points in the first 5 minutes. I don't know what time this hit here, but you get the idea. First 10 minutes gave you 50 points. I don't care if it goes back here. 50 points is 50 points. Same thing. But if I explain this short in that manner, it's going to get you in trouble. So I'm not going to do that. Even though we have a high here, pushed up, didn't make a new high, then we drop. So we know that that's internal liquidity. High, higher high. Close below here. Bias is retracing short. There is no key level to sell from. Both of these, this, they're below here. So when I said that you have too much faith in candlesticks and not time, maybe I didn't say not time. Too much faith in candlesticks would be that you see a pattern here and you understand the pattern, you just go short. And this happens to like a lot of persons. Let's say you went short here, right on that week because you saw that. You went short, it dropped fast, whoa, pulled back, 40 points. And it started to go lower. Not having a context behind why you want this expansion and just focusing on the fact that you want this sell will have you mismanaging this trade a lot of times. Because let's be real. How many persons would see this? You go along, it runs into something like this, you close, it hits this, you go short. How many persons would think that it's not going to take this low? Not a lot. Anybody who sells here wants to get these lows to get taken. I sell this, I just want 20 to 50 points. So I'm out and somebody's still, and then you get cooked. Or worst case scenario, it comes back and then you're like, now it's moving because now we have nothing paired with a really nice interfractal. This must be A plus. No, that's not how it works. So you get cooked. I wonder if Leon is on the call. I don't think he is. One of them boys asleep. I was asking because this interfractal here, the same one I showed you, there's another caveat to it, which you've probably seen and not realized that you saw it. Hey, Steve. Yeah, it's been recorded. The other caveat to it is it's right there. That's why I remembered. And I think I've had that conversation with Leon, so I was dragging him into this. Let's say you have one big down candle. Up candle, but we don't close through here. And another candle prints, and it closed through there. That's your key level. If you are super precise, then you're probably trying to get this low if it's higher. But then this is going to open up a whole different conversation about which low is lower, this one or this one. And I don't want to drive you crazy. But just know that if you have your big down candle, and you have multiple candles inside here, find the body. I don't know what candle. Find the body of this candle. So you have big down candle, candle 1, candle 2, the lower portion of the body of candle 2, and then you look for something like this, and then you'll find it somewhere else. You'll find it. You'll go look and you'll see it. I mention it again because I saw it here, and I know that I expect Leon to see it as well. So that's why 2 consecutive up close candles. First one closing above. This closes, didn't go below here. The key level is going to be there. So this is a short right there. Game over. This is for somebody who is. No, all right, let's just leave that. Just know this is another fractal of the.
Say the thing, man. Say the thing, man.
No, I don't want to overcomplicate something that I've already made so simple. That's why.
Okay.
Mac trying to crucify me. 4 a.m. Same thing. I'll just run through the week since I'm already at Thursday. Somebody asked if I can go through my Friday trades. So here's the thing. There are some stuff that are not for irresponsible traders. Don't take offense. I'm not trying to say that you're irresponsible, but I can't honestly tell somebody to trade without stops if you haven't been baptized in the fire of failure. So you understand what happens when you're doing this type of thing and you fully accept that, hey, listen, trading without a stop loss is not something to entertain, but if I'm doing it, this is how I would do it. Oh wait, I don't think it makes any sense to go through this. But 8 o'clock. There's 8 o'clock. 150. Less than 100 points. See? Less than 100 points overnight sessions. I expect them to go outside of it. What does that mean? So you see, let me get this line off. If ONS is less than 100 points, I don't expect after 8 o'clock, and in particular equities open, we're going to stay inside here. That is the first thing that says something is going on. So I'm coming into this market, let's say Wednesday I'm bearish. With a bearish expectation, I want to short above highs. I don't want to see something that wants to leave highs intact. If I'm bullish, I want to buy below this low. I wanted to run that low. Hashtag running that low, fractal here. Bodies below here is breakaway gap. So I want to do this to me. Let's play around with a little bit of uncertainty. As we go into Friday, I'm gonna look if there's the first time we put a candle high below here. So nonetheless, choppy day. Moving on, going into Friday now, 4 a.m. Wait, I need to go back to what I said I was going to do. Yeah, so where's the first high that's below here? Key level. No bodies means breakaway gaps. Hits it, I'm selling the next candle. If I have this on my chart, I had this on my chart. It hits it like this, and I'm selling the very next candle. And if this is an M1, I'm selling the very next candle as well. I'm not selling anymore. Right here, no more sells. Are you going to buy it? I don't know. I don't know what's going to print. Down candle, up candle, I'm buying this. Use the support. And then I would target this high. And you're going to say, why that high? Because it's overnight session high that didn't get run because of whatever madness was taking place here. 50 points, didn't get the high. Okay. Break even. I get taken, no more buying. Buy side liquidity pool has been purged from the market. Lower. I sold this on Friday. I think. No, I don't think that was that early. Yeah, I think it was pretty early. But that's not why I sold it. So let's do the Friday portion of the ONS stuff. 4, 8. You won't see me trading a lot of times before 8 o'clock. It's my own personal rules. Every now and then, my life requires that if I want to trade, not that I have to, if I want to trade, then I have to play around a little bit. And I actually took a short inside here somewhere. People. I think this was it. They don't like me. Oh, I think I might need to do this first. Yeah, this was I was playing around with people. I just remembered. Why am I not sleeping at that time of the day? No idea. Nonetheless, liquidity pool. This is not classic breakaway gap because you don't have a run on the liquidity pool followed by a close below. Unless you're going to dissect everything here, which not necessary. So you'd be looking at this low, and that's how you derive your bias. Where's the high below here? Right here. You derive your bias from right there. I took this long, and I won. I took this short, but I think I entered here after the break. So same thing again here, pretty straightforward. 8 p.m. 8 a.m. came in, ONS 199. So this is over 100 points. So if it's over 100 points and you have volatility, it's going to go far. Far, far, far. It's going to go far. If it's over 100 points and there's no volatility or there's no AM morning volatility, stay inside the range. Ice up candle, lowest down candle, pong, pong, pong. Breaks here, same logic. If this is the breakaway gap, that's the high I'm interested in. I'm interested in them putting something there, then going. We can dissect this all you want to find 50% on all that and then try to form fit why this happens. We don't really care about that. What we know is this is the high right there. We traded above it. We broke hard at equities open. Order block. Short, simple. This, the reason for the long here is not going to sit well with a lot of persons. Here, let me show you something. This delivery here is inefficient. Very, very inefficient. Why? Since this candle closed and a new delivery started like this, one-sided. I'm not going to do much more than this. Then we can wrap up some questions. Here, no down candles. Ignore the one on the left. No down candles. We go above. You want a 3-bar high above here. This is the first one. When this happens, you now know once 3-bar highs start to print, this market is stopping. And it's not as simple as you might think, like, oh, 3-bar high stopping. The delivery is one-sided. When 3-bar highs start to print, that's when it's stopping. So now you can start finding your key level. So I'm going to move this. Key level. At my key level, if this is going to go lower, something bearish will print here to push this guy below here. Okay, big doji candle. What does that mean at my key level? Nothing at all. Up candle closed above my key level. What does that mean? Potential order block. 3-bar high. This is not bearish. Up candle. We start expanding through the low. Now we have a bearish fractal. Target there. That was said very loosely, but I think about it a little bit. First 3-bar low below here would have been here. So now what do we have? Buy side. Sell side. Whoosh. If we're going to go lower, this needs retracement and expansion. But where is it going to retrace to? I wonder. Kidding, I don't. Premium. Order block at premium. Dealing range. Trading range. By now, everybody should understand that I never put, even if I frame the trading range, liquidity is what we target. Liquidity is going to be here at this candle at 10.15. It's not going to be down here. It's not at 10.10. It's a sweep. So slap the good old RR tool on. 50% of the imbalance, initial imbalance. Order block. This is precisely the same as the The one we looked at before. Let's leave it there, doesn't matter. 923. That's a lot of points. Simple and mechanical. Right, it comes back up. Rejects. This you can ignore. This places. I did not sell this. I sold in here. It's probably in a 1 minute chart, if I'm being honest. Yeah. 1 minute chart. My entry was somewhere in this region, I think. Yeah. The exact dynamics don't really matter, but yeah. On this chart, I went long to get this, but I wasn't at my chart at this time. So I couldn't have gotten here. So in real time in the recording, you can see I framed support around this big wick up and a big body through it. IRB, once you flip from wick to body and not wick to wick. So I don't want to see them trying to get below here. If it's going below here, just a wick this low and run again. So I went long inside here, targeting this, and then I got all that on the left. Simple. Did not hold for this, did not want it, just wanted this. Yeah. Where was the other short? I don't remember here. But I took 9. I took 9 of those trades on Friday. This was the last one. So the analysis portion, the review portion, recommendation for how to trade ONS, how to gather data. That portion is done. Now we can take some questions. Taking a break from trade almost. So I haven't done any live calls since late last year because I was testing something. One, not much of a the live sessions initially were, us reading price together and then trading whenever opportunities popped up. But I think as more persons started to find their own way, persons started to interact less. And what's the point of a live call without interaction unless it's like just a lesson or a lecture? So I haven't done any live calls yet. I'm not really doing much. I'm scalping, yes, but I'm not really doing much until like maybe February. So maybe next week. I'll resume live calls next week, Tuesday. Yeah. But as I said, most persons are not comfortable. No point in imposing my bias on persons that I want to be independent. I'll share my chart. I'll share my key levels. But at the end of the day, you need to be independent. All right. Any more questions? Take that as a no. As far as the review
Kish,
hey,
I had a question. When you had let me try to remember. Yeah, went over the breakaway gap,
Mhm.
and it was more of the example. It wasn't an actual wick there, but you drew the wick.
Mhm.
Was that due to the stop hunt and then the bag being created after the stop hunt? That makes sense.
So let's do this. let's say we have a range here. Okay. And the dynamics of the range looks like this. There's a high inside there, then a higher high. Let's just put it right there for now. If we have liquidity being taken, this high taking liquidity, not necessarily the internal one, but something on the left, then I have context as to why this is likely to stay in the market. So from a breakaway gap standpoint, we would need to see the liquidity right there being taken. It could be liquidity being taken can be offset, which is why it does not have to be a body close. It could be a wick. Price could wick there, and we say, okay, that shows liquidity taken, or it shows a run on sell side. What we want now is to see commitment of price below a stop run, so that I know it wasn't a stop run to go the next direction. Which means I want to see this. Then that. This candle must close below here. This does not have to close below here. Now, if this is a 4-step process, 1, 2, 3, 4, what I was saying is, if you represent this on a candle or a candlestick, it could be 1 candle, 2 candles, 3 candles, 4 candles. Okay, let's make them a little bit. We need to go inside this one, so this can be smaller. This will have to go inside. Let's make that one bigger. Okay, what I'm saying is, if you look at this here as a 4-step process, that could potentially print in 4 candles. Not a requirement, but it could. The process is more important. The candlestick is just a representation of an instance of the process. What I'm saying is this. We can have this happening here. And if that happens, the candle will look like this. It's still going to depict or represent this idea here, but it's going to be different. So that's one instance. Now, if you have, take this off, this taking place, in this process, if we superimpose this like here, and we make sure that the arrows are inside candles, push this over a little bit. There are some elements of the process that are missing. Missing in the sense that it's not inside a candle. So how do we account for that in a process that's supposed to be mechanical? First way, now everything is accounted for. This retracement is done in that wick. This pullback is done in that wick. If this is the candle, and this was here, then this portion is still accounted for in that wick, because it would come down and then go up. So what I'm saying is, the process of how we print buy side, sell side, retrace, expand, potential breakaway gap down here, it's all a process. It's not just candlesticks. I was trying to get at this maybe a couple of days ago when I said that too much faith in candlesticks and trusting that a pattern must print like this is what holds persons back from seeing that they can read price better than they think, which means you can make better decisions than you think. This portion here, however, if we have the process printing like this, where we get the wick taken here, and I don't need to say and I'm expecting a bearish breakaway gap there. I'm gonna grab this. I'm gonna wait for this candle to close. I'm gonna find the next high. I'm gonna whisper, do not fill this in. Do not balance all of this. Wick, fine, nobody's up here and then it dies. So I can see this way before any of the candles sprint. Understanding this logic, I can anticipate it. I can see two green candles here print, and I watch if there's a wick below it. And I know that, okay, there's no wick below it. So if I see this wicks here, but does not take this out, doesn't mean anything. We could wick here and then pump again. And then this process here becomes way more than 2 or 3 candles. So this part here gets done all the way over here and shifts this to taking longer. In the same way you have
Delayed.
Hey, stop reading my mind. In the same way you have immediate rebalance, there are delayed rebalances as well. You have immediate deliveries, you have delayed deliveries as well. But the process stays the same. It needs to do 1, 2, 3. It does not need to do 1, 2, 3 in 3 candles. So sometimes, especially if you look at a lot of persons who execute live, most times the good ones will point to focus down here. This is where the draw is, or eyes down here. I think Zeus does that. I like watching his videos, and the rest is just straightforward. So I like to call it bar by bar analysis, which is when you become a trading nut job. When you become so obsessed with trading that you can see inside candles or anticipate what inside the candles look like, that's when you become a nut job. It's like here. Make it bigger. We open, runs higher, retraces, and it pumps. First expectation, sell side is down here. So bar by bar analysis, each candle's reading each candle, what the next candle is supposed to do. That's what comes into play here. High, higher high. We continue with the drawing it like this. Next thing I need to check is, did the sweep liquidity? Failure swing. Okay, nice. So we have buy side. We need to see sell side run in retracement and expansion. Market drops. By the way, the sell side liquidity must come from the left of this. So this is 255. When you have buy side run, the sell side liquid that's been taken must come from over here. Must come from over here. So buy side, sell side, retrace, expand. The market drops. Did it take sell side? No. But it's retracing. Here's a fun part. Close 1. 2. 3. What's missing here? This is not a trick question. What's missing? In a 4-step process, what's missing? SSL. Okay. In all of the examples that I showed so far, one thing has been constant. The process. There are 4 elements to the process. Buy side, sell side, retrace, and expand. We have buy side, retracement. The process requires 2 more steps. Those 2 steps are sell side and expand. What does that tell you about what to expect? Not a trick question again.
Sell side and then expansion, so it shouldn't have to. We shouldn't have to worry about the retracement.
That's it. Now, how do you use that to trade? Once this is done, you start selling above the open prices of candles. Landslide. That's it. The thing about it, like realistically. If I know that it's 4 steps to the process and I see a whole lot of buy side and sell side and retracement and expansion, and usually it's the retracement that gets me missing the ideal entry, because I think it's going to retrace to here, so I do this, or I think it's going to do this and I do that, or I think it's going to do that. When I can see this and I know sell side and expansion is coming next, full margin. Well, kidding, trade responsibly, but it gives me a certain amount of, or a certain degree of confidence. So if you start seeing elements of the process missing, you can still trade, but understand that these are missing. So don't let candlesticks start telling you otherwise. Liquidity not taken, it retraces, no buy side, and you just start selling into the order block and put your stop right at the high. Wick takes you out. Sell side expand. You missed the entry. Oh gosh. How did that happen? Why did I not see that? Here. Sell side and expand. Ain't no retracement. Take it to a 1-minute chart now to refine. Because who doesn't love a good refinement? Look how pronounced it is now here. Buy side run, drops, doesn't take sell side, retraces. You start selling above candle opens. Sell side and expand. Sell side, FEG is going to print somewhere down here. This is something that you should know as well. Everybody who trades breakaway gap. I'm assuming that the folks already know it, but in the event that you don't, you should know what happens when you have a sell side run or buy side run in an area we're expecting breakaway gap to print, and they put an order block there, or they print an up candle or a down candle, depending on what you're looking at. You need to know this. I would advise, right? I would advise that you need to know this. Saves you a whole lot of. You kindly upload the recording of the live session. Yeah. Once I do a public call, you get it. No worries. But yeah, these are the, they don't feel like a lot, and they don't feel sexy enough to say, yeah. But when you think about it, these are the things that you probably missed in a lot of good trades or in a lot of live executions that would have saved you from pain and heartache. No expansions. Look at the videos yesterday. Let me see if I can find a 1 minute. I look at the first short. This I was trading a timed run, like 100%. I'm trading a timed run. Okay. I like to see price be delivered like this. Whenever I have big FEGs here, expansion leg, second FEG is where they retrace to. First one is a breakaway. First one is a breakaway gap. We expand key level in a expansions and order block. I know that here, I'll put a different color, and here, these are the key levels. This one to potentially push the market back to make a new high, because once it goes below here with body, then it's going low. And that's what breakaway gaps do. Here is where they can retrace to. Look what happened here. We trade up, same stuff, higher high. Then put this on, no extra charge. Between here and here, market structure shift. If you want to look at it like that, buy side, sell side. My short was all over here. I could put a lot of them in there, but the point is reject that. That's the high. I want to see them reject that high, so I started shorting inside here. Take a look at this. If we have buy side and it drops, retrace before this low gets taken out, sell side and expand. But this is a 1 minute chart. This is a 1 minute chart. In 1 minute, when you're trading 1 minute chart, you can still use the same rules, but there are a few things that you might need to know to just keep that in mind. This is a sell side liquidity I want because it's always the one inside here. So all of this here is a fractal within a fractal. So think about it. This is the FEG I want them to retrace to. That low is going to be the sell side liquidity. Sell side liquidity taken there. I start selling. Anything inside here is going to should act as bearish confluences to push it lower. Doesn't look like a beautiful trade, but this is 93. This is 69. It's 30 points. Ignore the RR tool. I had no stop loss. Lots of practice, lots of refinement. You find out ways when you don't need to use a stop loss. That's it. Once this gives way, we're wrecking the expansion. The start of expansions must be important algorithmically. That's basically where the order blocks should print for bullish order blocks. So if it's trying to wreck bullish arrays, no bueno for higher prices. No bueno. FEGs, everything here overlapping. This is also something that, again, I think everybody knows. When you're looking at deliveries and it prints volume imbalances like that, it has to stay above this to be bullish. So even if it goes through and fills it right to the tick, it needs bodies above it for it to act as support. You can't act as support when you're below the level. So by this time I was already done. And yeah. So one simple logic with enough understanding can show you a big words, a plethora of setups everywhere. Where's your liquidity pool? So it was over here. Takes bam. High, higher high. This market becomes bearish. And the daily chart closes below there. Daily chart closes below there, all the way down here. This is the breakaway gap. This is the second FVG. We already retraced. That's simple. Where's sell side liquidity? Failure swings. Low. Tag that. No, this is not the failure swing. Or this is not the on top liquidity. On top liquidity is here. We haven't gotten any of that yet. That's the chart I showed first. That's where I'm looking for the market to be drawn to next. But yeah, same rules, nothing changes. If we want to push it a little bit further, the last time we had buy side liquidity was right here. They're not 3-bar highs here, but they're daily highs, so you could probably find a little bit more oomph in them. I'm losing my faith in the daily chart lately. Highs, higher highs. So heaviness is the low between all of it. Between all of these, when it closes below here, buy side, sell side, retrace, expand. That simple. But yeah, EO on a higher time frame. I did. I think it's in this chart. This one right here. Weekly range. Daily high. Pump above it. This candle, November the 7th, EO. So the range starts here, opens, goes up, comes down, pumps, new high. This is the last time we made a significant daily range. So below here is them leaving the range. And also below here is what makes this bearish. That's how you look at stuff. So when it's trading into this low, one of two things. It's going to reject and go higher, or it's going to close below here, or it's going to reject here. But either way, this area, if you want to put it like that, is where I believe the drawn liquidity is for the market right now. Just about how it gets there so that we can identify your key levels while they're being printed. But no fuss, no muss. I'm scalping either way. It won't matter to me. But as I mentioned, Tuesday high of the week, CPI. If it's not, and we're still in choppy territory, then Tuesday will pump us right back up into this old area. But I'm just looking for the high of the week. At the moment, without seeing what next week looks like, I'm looking for Tuesday high of the week. If Tuesday gets animated, buy side liquidity. And then I still look for shorts again. With the information I have now, that's the plan. But yeah, one example of range creation, order submission, order pairing. One example. Okay. Let's bam. Let's go M5. Let's go M1. 10 o'clock. 10 o'clock H1 candle. There it is. Everything down here where's the left side of the curve? It's not actually left side. I'm just using lingo that makes it easier to talk about this. All of this right here is order submission. All of this. Okay? Order submission. What happens right here? Orders are being filled. Market turns around. Settlement price is going to be above here. Why? Because in the world of finance, valuation is important. So if you're buying for $1 to make money, you want to sell it back for $2. Something. I'm trying to pick my words here to explain something very technical with stuff that are not technical. So forgive me. The range that this is trading in has to come before the orders are submitted. Why? Because the submission must come from orders coming in above or below the range, like a consolidation. So you want to look here and find your consolidation. That consolidation is your range created. There. Range created. Orders are submitted, filled and matched, settled right there at average price. One example. Overnight session profiles are delivery fractals. Like, if you haven't seen that by now, and I don't know. Like, just remember when I talked about them. 5 profiles, they print more times than not. Once you can see overnight session, it's very easy to determine, what profile to expect. You just need 4 a.m. I said need, not want. You just need to be able to see this. 4 to 8 a.m. If you can see that much range, you can determine what you want to do. You may not be able to determine that now because you haven't spent enough time. Everything you need is there. What might be tripping out a person's up is just like persons don't know how to read PD arrays. You just go to the chart and you go, here's a low, here's a high. Market trades down. This is an order block. This is a market maker model. I'm going to buy to take that higher out. Market goes, it goes, it goes. Retraces, buy, stopped out. Or, you form fit it to this high and say, oh, that was a high. That's not true. It's not how it works. In my opinion, in my humble opinion, that's not how it works. If you're going to use anything here as a convincing high of the market, you have to look for the displacements first. This cannot be the high. This has to be the high right there. So what does that tell you? The high was run. If the high was run, then I have order blocks. If the high was run, the order blocks are going to be inside here. Look at all of this. The last time we broke is here. This high was run. If anything here is going to get run again, wouldn't it be that? Like, think about it. Think about it. If the market was a mean kid with a magnifying glass, buy side liquidity run multiple times. We broke hard. Like, it broke hard right there. 2 down candles. This is, see the fractal here again that I was talking about. Up candles. This closes that below here. So you target right there as your key level. For bonds, let's keep the key level on. Always important. We run the key level, broke. This is the liquidity pool below the key level. If I'm going to trade, I want to trade from there. Didn't get there. We don't need the high on anymore. These are the levels they're going to watch for an entry. Liquidity, tag, no order block, order block. Runs the key level again. Breakaway gap. Buy side. Retrace. No sell side yet. Buy side, retrace. Sell side and expansion is coming next. So if sell side and expansion is coming next, breakaway gaps are going to form, which means FEGs will stay open, which means sell above the open price of candles and then let it rip. That's it. The only difference the only thing I'd say to do to make it a little bit more responsible, bar by bar is not for everybody. Especially if you are a stickler for it must move now, bar by bar is not for you. Because with bar by bar, you could be trading a 5-minute bar by bar inside a 1-minute bar by bar, and you don't know that the 5-minute needs to retrace a little bit more. So the 1 minute is here, and it might run a high again, and you're like, why is it doing this? Oh, you get frustrated, and then it plays out. And then you feel like somebody's watching you, because how could it stop me out exactly where I don't want it to go and turn around and crash 1,000,000 points? It's something that you have to get used to. You have to get used to trading M5 candles and M1 candles in tandem with each other. And that's what will open up time for you a little bit more. Time. Like, okay, I'm just gonna use the time that's here. 1:52, right? Friday 10 a.m., Friday the 10th, 1:52 p.m. Coincidentally, this overlaps with something. I know for a fact that I could put a line right there. And I know what it means if it closes or fails to close below here. What does it mean? What does it mean? That is holding a pool of liquidity. That's the range low. Range low was run here with that wick. So what have we been talking about? So like, part of me just feel like I sound like ICT a while ago. Sorry. So what does that mean if we have range low holding liquidity and it gets run? You're going to move your focus to the candle that runs it. Then you're going to go to the candle that closes below it. And you're going to say, do not fill that FEG. Wow. Listen, folks. But yeah, beautiful, beautiful, beautiful. It's not difficult. It's just, it's not a macro. It's not hang my head. That's not a macro at all.
I was going to ask you, are there any other uses for stop hunts? But I guess it could be used in order pair. Well, it is used in order pairing as well.
Yeah, but I may have said this before, but I just want to reiterate it again. Trade, there's a whole lot of different multifaceted trade understanding. Your goal should not be, as fun as it is to sit down and talk about trading or teach somebody to trade, your goal should not be to become an encyclopedia about trading concepts or trading terms. That should never be your goal. Because if that becomes your goal, you will know a whole lot of stuff and you don't know how to trade them. Your goal should be how to trade this idea, how to trade this condition, how to trade this, whatever that is. Okay? Stop runs happen. They happen. If my intention is to understand stop run, I will never stop learning. Full stop. You cannot fully understand stop run unless you somehow got access to some information that transcends everything else. But it is not my belief that you can fully understand stop run. but you can understand how to trade stop runs. Okay? If it's a stop run, the market should go the next direction. Simple. That's the most basic understanding of stop runs. If it is a stop run, it means the market is intended to go the next direction. So if this is a stop run, we're bearish. If this is a stop run, we're bullish. So what does that tell me? It tells me that if we're trying to break and close below a stop run, we're bearish. If we're trying to break and close above a stop run, we're bullish. But that by itself will tell me, what to do or what to look for. Stop run, we close below. Try not to look for any bias cliche. Simple. So if you're going to look for sells, what do I need to know to have a good sell? Take this off. We just broke below that stop run. What do I need to know to have a good sell? Well, in bearish conditions, we look to pair orders at buy side liquidity. This is the stop run. There shouldn't be any buy side liquidity above here. Shouldn't. Not saying that they can't be. Don't have that power. There's my buy side liquidity. And that's why I mentioned that with big FEGs, I focus on liquidity being, if it's like big candles going up, I focus on liquidity being below that low. Down candles close below it, I get an order block. Suddenly, this doesn't feel like, something that can hurt me. I can trust going long. Okay. Big down FEG. Same thing as this. So a reverse. So can I look for the reverse setup? I will. I'm going to look for an up candle to close above the liquidity pool, and I'm going to short it as a bearish order block. There it is. There's the high. Up candle closed above it. Okay. Let's pull it out a little bit more for the aesthetics. Just aesthetic. This is all just aesthetics, right? Just aesthetics. Big up candle, order block. Look at all the happenings inside here. On this call earlier, I mentioned that when it happens like this, you focus your key level on being the second candle body right there. Now look at all the confluence. Premium. Adjust the aesthetics. There. We have premium, key level. Where's the RR tool to make it look pretty? Right on the higher there. First of all, selling this immediately means you're trading for this low, okay? Or this failure swing. So if you're not comfortable with a trade from price level 919 to 882, this is not for you. You have to frame what you want and then execute based on that. Versus, it's consecutive down close candles. It's not going higher. We run a high. I'm just going to short. Oh, it works out. Nice. I'm gonna do it again. Well, you can trade like that, but that's not how I would advise you to trade. You're getting your entry right there at that key level. Your stop is above the high. If you're not stingy with the stop, give the trade breathing room. What am I looking for next? Between all of this, if that's my range, where do we leave the range? Or where's the last stop run? The last time we ran stops was right here. So the failure swing above that, closest pool of liquidity. Already run. There's no liquidity pools here inside besides this one. This is the first place that has a liquidity pool. What I mean by that, if you don't understand, is anything that was below 249 was run because this is low. So you need a higher low to know how's liquidity to be taken. 251, higher low. 252 raids that. This is the last time, 253, that we had liquidity at a low, and we haven't gotten a lower low yet. Buy side, running the highs up here. Sell side, retrace. expansion. So what does that mean? If liquidity is here and it was taken here, I'm going to pull this candle low that took the liquidity out in time, right there. Why? Because breakaway gaps are going to print right there. So when we close below, I'm going to find the high that comes right under this one. This is a low, not a high, right? That's the high. Stay open. It stays open. Aesthetics. This is understanding. This is not 1 minute chart derived. This is everywhere.
Appreciate it, Kish. Yeah, I went back and looked at the order pairing video on YouTube, and just things kind of been coming to my head, and I don't know, just kind of wanted to mention it to you. I appreciate it.
All good, all good, all good. But yeah, I think there's enough things in this video, which is very basic and very simple, that can help persons stop trying to learn new things, stop trying to search for new things, and just look for instances where this works, journal it, look for instances where it doesn't work, air quotes, journal it, find that balance that says, I can see this happening on this time frame, just execute. Like, look how messy it looks without anything on it. Look how form-fitted. If you saw me selling this, it would just be amazement. Like, why? Why there? If I recorded myself taking this trade and I put that on, I said this is going to stay open. You look at it and like, why? Why the hell did he pick that one? Look how many effigies are there. Nothing I trade is arbitrary. Everything I trade, precise set of rules. I can show you my entire rule set from 2019 when I just started trading, when I learned order blocks, and order blocks crushed me completely. My very, very, very first trading rule is any order block I select must break market structure. Let me see if I can find one. And wrap up this call. So if you're new to ICT, or when you were new to ICT, you remember when you just see a down candle and an expansion, and then you start saying that since the down candle was there and it's the last one before the expansion, it must be an order block. And then this worked. Beautiful. What I used to do is specifically say, if there's a down candle and a push, that push must take a high. So if you've been with me since 2021, when I started our Telegram group, and I shared rules of engagement. Rule number 1, all OB candidates must take like liquidity or market structure. I don't remember how I worded it. Whatever that was, I don't remember how I worded it, but that's what it was. That was my first trading rule. That got me out of stupid trades trying to buy here, and it failed. All that. Bro, everything I share, it's never, it's the flavor of the month. It's always something that stems from a conversation. So this is coming, like everything that we're talking about now, it's coming from a conversation I had with someone. I don't do calls or videos or lectures unless I get inspired to do them. Not a content machine, okay? I don't just spit out content. Every time somebody shows me a problem that they're having and I try to help them, I get inspired to help somebody else with the same problem. So I make a video like this and I touch on the points that they're struggling with. So not only can they see it, but somebody else. But yeah, don't want to make this into a emotional. Hey, who's that? See, rule number 1, raid. All order block candidates must rate a high or low. There's it. See? Man. Good times, man. Good times, good times. That was like years ago. But yeah, good, good talk, good talk, good talk.
Appreciate you, Kish.
Any other questions? If not, we can wrap up this one here. And
I had posted in Discord the order pairing video with the indicator.
Mhm.
And I guess is that like a good study to kind of pair those two together?
yeah. So in closing, whether it be because of my analytic personality or just divine blessing, right? I have a gift where I can put things together. And that's what I think. So I shared elements of the entire trading journey that I think because of those understandings, I'm able to read price light. I'm able to deduce in real time if this candle is likely to be bullish or bearish or stuff like that. Sometimes it is hard to show persons something like that unless they're ready to receive it. And most persons are still hung up on whatever is currently the flavor of the month on social media, especially if they see somebody trading with it. So order pairing, stuff that goes all the way back to Keys to Trade in New York, all of that. Those are my way of creating a like a roadmap. The end goal is to be able to trade profitably and consistently, not be an encyclopedia. But the understanding of these things and practicing them, that's what will lead you to that point. And if you remember, we had a PIP group at one point in time, and that group was designed to basically put the ideas together. I don't remember if I still have it. I may or may not have. PIP was performance improvement plan. So if you understand everything and you struggle to put it together, then you go in the PIP group and we would do liquidity hunter assignments. If you remember that, then you've been here for a while. If you don't, then no worries. Order pairing, knowing where the market is building a book is important because outside of candlesticks, that's what's happening in the market. Banks and institutions are building books, submitting them. CME, you remember when CME was the flavor of the month? CME, 90-minute cycles, all that madness. Everybody was brainwashing to believe in 90-minute cycles was a real thing. It's still not, but let me not. I don't want to go there. I had to find a way to not come off as this egotistical trader person who knows nothing, but just a regular guy who did the regular studying just like you, probably put in a little bit more hours, realize that these things repeat, theorize them, put them together, put a rule set around them to improve that, and now I'm here. Order pairing is a must. You have to learn order pairing. If you don't learn order pairing, then why are you trading order blocks? Because order blocks is the pairing of orders. And that's why order block theory is not mine, and I would never dare to say it is. But my interpretation of what an order block should look like, not to sound like an ICT, but as far as I know, everybody was looking at the last up candle and last down candle before. But once I share that those don't work for me, I look at it as this, whether you close or not. Then, things start to heat up. And there are theories that I've briefly introduced, like 915 theory. I did not create 915 theory. Well, or the general logic behind it. But what I now know for a fact about 915 theory is mine. So from 2021, 2022, when I shared that, I've never done another video on it for a reason. It will destroy a lot of persons' expectations of what this is. But did the VIP group make it to the island yet? The island series, you mean? Or if folks came to see me? Bank Holiday was here in Christmas. I think a couple other guys coming soon too.
No, I meant the Island series.
The island series is still on PowerPoint. I should get them done. I really should. I'm gonna make a concerted effort to get those done. I've said it a million times, I know, a million times. But something tells me, like I said earlier, it's the inspiration behind it that drives me to get it completed. And something tells me that even though I want to do it, it's not what I should be doing. So I've made so many videos after that. I don't know how else to explain it. The inspiration that says this is what the guys need is just not there. I don't think that's what you need.
The spirit no move yet, man.
Yeah, the spirit hasn't said that, Kishan, this is what the guys need right now, get it done. It's saying that this is what I need to do. So hence I woke up at 5 o'clock and I'm on a Zoom call until like 7:44. Those things don't happen. I don't get up this early on a Saturday morning. If you know me, you know. But I'm a very spiritual person. I don't believe in coincidences. And I don't know what else to say. But yeah. Not anytime I say I'm going to share 915 theory in its entirety, everybody who's ever entertained anything time related will throw it away. I promise you that. Anytime. But as usual, it's always going to be somebody that says, I mean, the entire Patreon playlist was apparently leaked and is now on some platform. Person still don't know why they want to do this. And my hard work is still my hard work. But yeah, I want to say this. Don't suffer in silence. I said it before, I said it multiple times. If you're in the group with somebody who's this willing, I'm not charging you an arm and a leg. I'm barely even charging you anything. Don't try to reinvent the wheel. I know that we like to say, if he can do it, you can too. Yes, I believe that wholeheartedly. But guidance. You think I'd have figured out order block theory if I didn't know ICT? Probably not. I'd probably still be trading indicators. And I could have traded indicator profitably. 1.9 EMA and one little modification. That's the difference between indicators and conventional use of indicators. If you keep linking indicators to print on the closing price of the candles, they will fail consistently. But if you ever go into an indicator and it says apply to, you look at the options that you have, there's one in there that makes trading a little bit easier. But it's besides the point. But yeah, Saturday morning, I think we've done enough. Right. I'm going to be a dad. I do hope that if nothing else, this has lit a fire in you to be a little bit more intentional in your trading journey, not just trying to absorb content, but be intentional in focusing on this thing because I see what this thing can do. Share your progress, you know. Let's grow together, man. I won't be here for long. My eyes are already not liking all the screen time. So once I start transitioning away from trading, you will start seeing more stuff, options coming in. I'll be coming, soon coming. All right, so my daughter's up. Time to go. But thank you guys for coming out. You've been a great a great audience. Man, lots of love, lots of love, lots of love. Hope you enjoy. Have a great weekend. Please feel free and comfortable to share charts in the group, right? Winning trades, losing trades, analysis that don't play out. Just share some charts so I can see what persons are doing, and it can help me to spot the gaps in the group, and then that will help me to create the content that you actually need and not the random stuff. But I will tell you this, very, very soon, I am going to remove the daily chart from my analysis. And then when that happens, we will have some fun. Do enjoy the rest of your day, guys. And see you in the group. I'm going to post the recording as soon as it's done.
Respect, big man.
Lots of love. Lots of
Thanks,
love.
Kish.